Hello, this is Jordan, and this video is being recorded on the evening of Thursday, March 16th, 2023. Thank you so much for joining me. And in this video, I have one simple message. There's macro, fundamental, and technical reasons for it, but this is the time to sell commodities and buy gold. So if you're an investor in hard assets, this is the time to get ready to go all in on gold, secondarily silver, and sell the other subsectors of commodities. And I just have a couple charts. And this is what I'm calling the commodity performance cycle. I just thought of this while I was putting this together. I don't know if somebody else has a term like that or this term, so I'm just going to perhaps coin it and trademark it just verbally here, the commodity performance cycle. And we also saw this in the 2000s. Of course, I need to study and look at the 70s, but I'm talking about more recently. Like, this has been true since the 2000s. In the commodity performance cycle is precious metals lead, and then eventually the other commodities, copper, oil, they do better. Well, oil is really a more late stage, but there's a cycle to how these things perform. And of course, there's points where they're all going up together and they're all going down together. But generally, if we're looking at the cyclical aspect, if we're looking at 12, 18, 24 months, that kind of performance period, then there are differences and divergences between how the various commodity groups perform. And so I just want to go back and look at, so we have gold and silver, and then we have the CRB at the bottom. So we're really looking at commodities X precious metals. But, and I've done some videos about this in the last year or so. And so the blue show significant bottoms, the red show the peaks. And so if we go back to 2016, yes, commodities bottom with gold and silver, but, gold and silver really led that move. And what's interesting is the CRB, other commodities, they still trended higher. I mean, you can see the CRB made higher highs in 2018. While, of course, gold and silver were still correcting. And so look at the red arrows that show the peaks. So the commodities peaked at the same time gold and silver had the significant cyclical bottom in the summer of 2018. So, I mean, it wasn't exactly at the same time, but you can see. So very interesting. Then, of course, the COVID crash low. I mean, it was a more significant low for the CRB, but, also significant for gold and silver. But gold and silver peaked, only 5 months after that. And as we can see, the CRB, commodities kept performing really well. They peaked in, early summer last year. And, look what happened. Look at the bottom in gold and silver. We got that a couple months after what's likely to be a significant peak in commodities. And at the same time, I'm going to say, I don't think it's that much of a stretch, that's a significant bottom in precious metals. So the last significant bottom in precious metals occurred only a couple months after a significant peak in commodities. So very similar to what happened in 2018. And also, you look at the CRB. That's also true when you look at the equal weighted index, the GCC. Well, this is actually the DBC ETF, so technically it's not the CRB, but close enough. But you can see, commodity prices, they've been rallying several times over the last, 6 months or so, 5-6 months. But I should have zoomed in there. But if you're looking at that trend line that the DBC just broke, it had rallied above that 3 or 4 different times in the last 6 months. And so now it's breaking down. So this is a significant breakdown in commodities. And look at gold and silver. With this latest breakdown in commodities, gold and silver have actually perked up. And so the macro fundamental reasoning behind these moves over the last 7 years, and the reason why gold and silver are, I don't want to say completely inversely correlated to inflation and inflation expectations, but in terms of the turning points, they have been. And so basically the reasoning is when you get a peak in inflation and inflation rolls over, like we're seeing now, like we saw in the summer of 2018, that means the Fed can print, for lack of a better explanation, if we're just dumbing it down to the simplest degree. When inflation peaks and rolls over, that means the Fed can print. When inflation and growth are going up, the Fed cannot print. And so that explains why in recent years, inflation and growth going up, if the economy is still growing when inflation is going up, precious metals are going to underperform, and you want to be in the other commodities. But at this point in time, when you're headed into a recession, it's probably going to be significant, significant bear market. So everything's going to get, as this bear market and recession unfold, which could be later this summer, maybe it starts in a month or two, I don't know. But as it unfolds, that's going to set the stage for a huge bull market in precious metals. Gold's going to move first. Then when it breaks 2,100, you're going to see silver and the mining stocks really, really outperform at that point. And again, that's because when inflation is going down, the Fed can print. When inflation is going down and the economy is going into a recession, the Fed is going to be forced to print at some point. So we're already seeing the expectations. The market, yesterday discounted 100 basis points of rate cuts. Cuts. That's a funny word. 100 basis points of rate cuts have already been discounted as of yesterday. So the market knows what's coming. I know I'm belaboring the point, but, and this has been true. It was true for most of the secular bull in the early 2000s. When inflation is peaked and it's rolling over and you have growth concerns, the Fed can print. And that's when you want to be in precious metals first and foremost. And then, I don't know, a year, 18 months from now, maybe the economy starts to rebound. Gold's trading at 3,500 or whatever. Silver's, close to 50 potentially. Just hypothetically, we see that kind of a move. Then the economy is looking like it's going to, gain traction for at least a little while. And inflation is still, really picking up again at that point. That's when you want to be in the other parts of the commodity trade and less so precious metals. And so last thing here, we'll take a look at the stock charts of, looking at these ETFs, copper stocks, uranium stocks, energy stocks, lithium stocks. And, by the way, going back, I should have put in some ratios, but if you're looking at, gold against oil, gold against copper, gold against commodities as a whole, those ratios, they're all trending up. They're at a 52-week high, 200-day moving averages sloping. Those are in solid early uptrends at this point. But, looking at the stocks here, I see significant downside potential in, all of these stocks. Copper stocks have been fairly strong. They've held up pretty well. But look, they really haven't, gone anywhere. It basically went sideways since early 21. And so, the ETF close to 35. I think you're going to see that come down close to 25. That looks like it's probably going to test that at some point. Uranium stocks, I did a video update at the beginning of the year saying, lithium and uranium stocks are going to be in trouble. They did, they had a good rally in January, both of them. If we look at lithium stocks at the bottom, just look at the 200-day. It's already broken down. LIT, it lost the 200-day in early 22. So that, to me, I think you're going to see real heavy selling there, over the coming weeks and months after we get this rally in the stock market. Energy stocks, XLE, that's been really strong. It just made a new high, but I would be a seller there. Energy is a late stage play. Oil is breaking down. If you have energy stocks, this is the time to take profits. It's not the time to be a buyer. It's way too soon. So I see XLE coming down at least to that support. What is that? 63, 64. Also, the 50% retracement is, I think, 55, 56. So, if you see the S&P coming down to 3,000, you're probably going to see energy, the XLE, in the 50s. Now back to the uranium stocks. I know this is really popular, but if you look at, so the 200-day moving average is that red line. I put it in red so it's easier to see, and you can see URA, that ETF. It basically lost the 200-day in the spring of 22, so about a year ago. Now it did have two rallies where it went above the 200-day, but there's a potential. This is kind of a potential bear flag, the blue trend lines. That's what it's signaling. I'm not a huge fan of trend lines unless you can connect 4 or 5 points to that line, then you can use it. And so in this case, the fourth point would be basically the failed rally. So, I mean, I don't want to say this is 100% a bear flag, but it's kind of semantics, because either way, uranium stocks are breaking down. They look really vulnerable here. And just anecdotally speaking, it just people talk about anecdotal. On Twitter, it's like 100% bullish on uranium. Like, nobody is bearish. I mean, Rick Rule's interviews, he's always popping up. He's bullish on uranium. So I mean, it's in a downtrend. This is not the time to try and be a hero or be a buyer. I stick by what I said at the beginning of the year for uranium stocks as well as lithium stocks. So I think we're just going to see more pain here in commodities. And, in real terms, it's going to be really good for gold. In my service and in the last article I did, I mean, I've talked about, what the downside potential could be for gold and silver stocks. But I'll talk more about that in the days and weeks ahead, especially for subscribers. Excuse me. Sorry, I'm babbling on a bit too much here. But, the final point is you want to be in precious metals now. Their time it's coming in the next couple months. And you want to be out of the other commodity plays because they're going into a bear market. So, yeah, that's the message. Wish I could have kept this video shorter. But there you go. Let me know in the comments what you think. Talk to you again in the next video.